All right, let's get into it. Today, we're taking a trip north of the border because for U.S. equipment finance companies, there is a massive opportunity just waiting. If you've been kicking around the idea of expansion, it turns out Canada might not just be a good idea, it might be an absolute necessity. So let's dive in.
And boom, right there. That's the main takeaway from a deep dive report by the Equipment Leasing and Finance Foundation. The message couldn't be clearer. Looking to Canada isn't just about finding new growth anymore. Nope, it's about protecting the business you've already built. Chances are your clients are already operating up there, and if you can't service them, well, you can be sure someone else will.
Now, these two charts right here, they tell a really powerful story. First, look at the graph on the left. See that steady blue line for Canada's business lending? It's just a consistent upward climb. Now compare that to the green US line. See that big, scary dip around 2008? It just shows a much more volatile boom and bust cycle. Okay, now shift your eyes to the right. That blue line for Canada's delinquency rates, it is consistently lower than the US line. So what's the picture here? A market that's way more stable and resilient.
So why the big dramatic word imperative? Well, it really boils down to a simple strategic question. Are you playing defense or are you playing offense? On defense, you gotta follow your customers where they go. But on offense, this is a mature, stable market that represents a totally logical next step for growing your business.
Okay, so the why is pretty clear. Now let's get to the what. What does this market actually look like on the ground? Let's map out the terrain and really size up this opportunity.
To really wrap your head around this, just think of Canada as California. No, seriously. With a population around 34 million and a GDP of $1.6 trillion, it is remarkably similar in scale to the Golden State. We're talking about a massive G7 economy here, but framing it like that, it suddenly feels a lot more accessible, doesn't it?
And just like the US, Canada isn't just one single uniform market. Not at all. It's really a collection of distinct, powerful economic regions, and each one has its own specialty. You've got finance and manufacturing in the center, oil and gas out in the prairies and up north. The opportunities are incredibly diverse. It really just depends on what kind of equipment you're financing.
And while those opportunities are spread out, if you want to know where the real hotspots for equipment finance are, well, the data points to three key provinces. Ontario is the undisputed economic engine, the financial hub of the country. Alberta is the energy powerhouse, driven by those huge oil reserves. And then you have Quebec, a massive market with 30% of all leased assets, but, and this is a big but, it's different.
And that word different is exactly what we need to dive into next. Because succeeding in Canada isn't just about showing up with a briefcase. It's about really understanding and navigating some key differences. But don't think of these as roadblocks. Think of them as critical intel you need to build a winning strategy. Let's look at a few.
First off, the whole risk profile is different. During the last major financial crisis, peak default rates in Canada topped out at just 3.75%. In the US, 6.5%. That points to a generally more conservative business culture. So what does that mean for you? It means your US-based credit scoring models might not work the same way. You're going to need a customized Canadian approach.
Second, you absolutely have to get your head around something called withholding tax. Now, for loans, it's not really an issue. But, and listen up here, if you're a U.S. company leasing to a Canadian company, their government is going to withhold 10% of the entire lease payment. Not just the interest, the whole thing. This can make you uncompetitive right out of the gate unless you structure your entry the right way to avoid it.
And third, we have to talk about the elephant in the room, Quebec. It is a vital market, you can't ignore it, but it operates under a totally different legal system. We're talking civil code, not common law, plus it has different language laws and a really distinct business culture. You absolutely, positively cannot treat it like just another part of Canada.
Just how different is it? Well, you'd think a simple transaction between two neighboring provinces, right, like Ontario and Quebec, should be straightforward. But as you're about to see, the complexity can pop up where you least expect it.
This quote comes from a real business owner just trying to figure things out. The rules around sales tax, where the service is supplied, who the customer is, it's just incredibly nuanced. It's the perfect illustration of how something that seems simple can turn into a regulatory maze. The takeaway? Local expertise in Quebec isn't a luxury, it is a flat-out necessity. Okay, so knowing all those challenges, you might be thinking, how do I even get started? Well, the good news is you don't have to reinvent the wheel here. There's a clear playbook with 5 distinct strategies for breaking into the Canadian market. And here they are.
You can just fund deals from your U.S. office, or you can go all in and form a Canadian subsidiary. You could partner up with a local player, use a third party to service your portfolio, or get into more complex financial structures like quasi-securitization, which is basically just bundling up and selling your Canadian deals to investors. Each path has its own pros and cons.
Let's just quickly compare the two most direct paths. Funding from the U.S. is the easiest way to dip your toe in the water, but you're going to get hit with that withholding tax on all your leases. Forming a subsidiary is the most common route for serious players. It solves the tax problem, but it comes with higher setup costs and more operational headaches. It's all about balancing cost, complexity, and that all-important tax efficiency.
And that brings the decision right back to your doorstep. There is no single right answer. It depends entirely on your company's goals, your appetite for risk, and what your clients actually need. Are you just testing the waters, or are you trying to build an empire up north?
So here's the bottom line. The data shows a stable, growing market sitting right next door, a market where your clients are already working. The challenges? They're real, for sure, but they are well known and completely manageable if you have the right strategy. The only question left is, are you ready to pick up the phone?